All right, $50,000. Call it the new $5 million, as the Carlyle Group becomes the latest firm to lower the threshold for investing in their funds. Is it time for you to go private equity? Jim Frischling, NewOak Capital co-founder and president, is here. And you say this move by Carlyle and the PE community overall, this is a game changer for how we invest our money.
Well, I mean, if you look at where we are today in terms of equity, equity markets at all-time highs, a low fixed income environment, and we've been talking about it's an environment where people should be putting risk on and investing money. Where do you do it? And here the PE firms are coming out saying we will lower what was traditionally a very high threshold, almost a very unique threshold of millions of dollars, and they're lowering it to what seems now to be more of a, certainly it's not chump change, but at $50,000, it's a far broader and larger audience that can now deploy capital and invest with these PE firms.
You're investing in these companies that they may own, Carlyle, KKR, et cetera, without a lot of regulatory issues. I mean, you get more freedom in private equity. The cost is higher, but you don't have the guys of the government on top of your head.
What I also find interesting is the SEC about a year ago actually had made amendments to the Investor Advisors Act, where they were actually raising the threshold of what would be considered a qualified investor, a qualified individual. On the flip side, the PE firms are lowering the actual amount of money that they would accept. So I do find that to be an interesting balance. We have some naysayers who are complaining the fee structures of some of these PE firms is rather high. If you think about the 1.5% of the Carlyle plus the feeder fee of 1.8, you're at 3.3% running. But if you look at their returns,
it's a high management fee. I understand.
Exactly. But if you look at their returns, I have to tell you, I actually think that might be a pretty good deal, considering the unique opportunities that firms like Carlyle, like Blackstone, and their peer group can get you access to.
You know, it almost makes you say, okay, well, I don't mind paying a 3% fee on the investment, because look at Carlyle Group. That stock year to date up 24%. KKR over the last year 36%. Blackstone up 33%. It even gets better. Year to date, you've got Apollo, year over year, Apollo up 66%. I'm sorry, but you've got the Dow up, what, 10% so far year to date? And then you've got year to date 55% gain on Fortress.
Right. And
I'm sorry, but the numbers just, that's the story.
The folks complaining about the fee structure, I think, are missing that big point, which is even on an after-fee basis, these returns are stellar relative to the other opportunities facing what I'll consider more, still high net worth, but still the retail investment community. So I think it's interesting they're doing it. Others are following suit, and I think they're going to raise their assets tremendously.
Big picture real quick, 1565.15 on the S&P. We may hit it today. We may have it on our hands. Are you buying into the party here, or are you a little more cautious?
I mean, we continue to believe that given the backdrop, and I know a lot of the bears are complaining this is all Fed-driven, but had you bet against this market or bet against the Fed, you have actually suffered tremendously. So we do think the environment is still ripe. We think the markets have stalled a little bit because they're watching the economy try to catch up, but we are seeing some pretty good data. So yes, we think we're going to continue to grind higher.
All right, Jim Frischling, interesting points from you today. Thank you very much. It's always interesting, but that was really interesting.
Thanks,
Jim.
Thank you.